Imagine trying to drive a $1 million supercar down the highway, but the parking brake is just entirely engaged.
Yeah, you're burning rubber, but you're not actually going anywhere.
Exactly. And that is exactly what the U.S. economy looks like today.
Welcome to Tech Money Madness, your daily U.S. stock market deep dive. It is July 27, 2026, and, if you're listening to this, you already know that trying to parse the daily market action can feel like drinking from a fire hose.
Oh, for sure. It's overwhelming.
It really is. So, we've got our hands on a comprehensive daily market briefing today, and our mission is to cut through that sheer wall of noise. Because underneath all the flashing ticker symbols, there is this massive structural tug-of-war happening.
Right. The supercar and the parking brake.
Exactly. On one side, we have these astronomical tech investments pulling the market violently forward into the future. That's our supercar engine. But on the other side, we've got heavy, stubborn macroeconomic realities. I'm talking inflation, interest rates, geopolitics, and they are trying to drag the whole system to a halt. You really cannot look at a stock chart today and make any sense of it if you aren't factoring in both of those competing forces. I mean, the technological ambitions of these companies are unprecedented, but they're trapped inside this incredibly restrictive financial environment right now.
So to understand why individual stocks are behaving so wildly today, we kind of have to look at that macroeconomic parking brake first, right? Because you can't understand the market without understanding the money supply.
No, you really can't. And right now, the Federal Reserve is flashing a major warning light on the economic dashboard regarding inflation.
Yeah, I saw that in the briefing. They're explicitly warning that if inflation stays above target for too long, it could entrench inflation expectations and trigger what they call a wage price spiral, which the briefing treats as basically a worst-case scenario.
Because it is. It's a nightmare for central banks.
Right. Well, to me, a wage price spiral sounds less like an economic theory and more like, feeding a campfire with its own ashes. Like you throw them back in, it flares up for a second, but eventually you just suffocate the fire while burning through all your actual wood.
That is a much more accurate way to look at it than just assuming, prices go up a little bit. To understand why central bankers lose sleep over this, you really have to look at the psychology of inflation.
Okay, break that down for us.
Well, when everyday people and businesses start to fundamentally believe that their money will be worth less next month than it is today, their behavior actually shifts.
They panic buy.
Sort of. I mean, you go to your boss and demand a raise, not to get ahead, but just to survive the grocery store.
Right.
Your boss gives you the raise, but now their labor costs have spiked. So to protect their margins, they hike the price of whatever good or service they sell. And that broader price hike hits the entire economy, which devalues your new salary.
Meaning you have to ask for another raise. The ashes go back into the fire.
Exactly. The cycle just feeds itself.
So what does this all mean for the Fed? How does a central bank actually intervene there without completely crushing the entire economy?
It's tough because they use a very blunt instrument, which is interest rates. By raising the cost of borrowing, the Fed essentially pours cold water on demand.
Because mortgages and business loans suddenly cost twice as much to service.
Right. So people buy fewer houses, businesses pause their expansions, and with fewer dollars chasing goods, businesses are forced to halt their price hikes, or they'll just lose their remaining customers.
But the danger is that pouring too much cold water doesn't just put out the inflation fire. It freezes the entire economy and we go into a recession.
Precisely. Which puts immense pressure on the upcoming Federal Reserve press conference. Chairman Kevin Warsh is expected to address what the briefing calls last week's supply shock.
Yeah, and while the specific details of that shock are still kind of rippling out, it is clearly weighing heavily on their strategy.
But we actually did get a tiny bit of a geopolitical relief valve today, right?
They did. Brent crude oil has slid below $90 a barrel, which is huge.
Yeah, and that's because a pause in U.S.-Iran hostilities appears to be holding for now. And you have to remember, energy costs are the invisible tax embedded in literally every physical good.
Right. If oil spikes, manufacturing costs rise, shipping costs rise, and that feeds right back into the inflation loop we were just talking about.
Exactly. So seeing crude dip below $90 buys the Fed some really crucial breathing room. It means they might not have to hike rates as aggressively to counteract that energy-driven inflation.
Now, it is definitely worth noting that the briefing highlights President Trump's recent commentary on this dynamic. He voiced support for Chairman Warsh, but explicitly insisted that the U.S. should have the lowest interest rates in the world.
Yeah, that made headlines today.
And I want to be super clear for you listening. Our goal here is just to look at the market mechanics impartially. We are not endorsing any political viewpoint or economic stance. We're simply conveying the facts in the briefing. But regardless of where anyone stands on the politics of that, investors have to price in what that kind of pressure means for an independent Fed, right?
Absolutely. From a purely analytical perspective, political pressure on a central bank introduces a totally new variable of risk.
How so?
Well, the entire reason central banks are designed to be independent is so they can make economically necessary but politically toxic decisions, like keeping interest rates high to choke off inflation without fearing the next election cycle.
Oh, I see.
Yeah, so when markets see political leaders demanding lower rates, institutional investors start trying to calculate whether the central bank will actually cave to that pressure.
And if the market believes the Fed will cut rates prematurely just to appease politicians, what happens?
Bond yields become immediately volatile because investors will just assume inflation is going to run hot again.
Yeah. Okay, so if the macro environment is the parking brake, big tech is acting like the brake cable has been entirely cut. This is the stuff where the numbers just stop making sense to me.
It's a completely different world over there.
Right. I mean, the market is terrified of tight money, yet the sheer volume of capital being unleashed in the tech sector right now completely defies gravity.
Because they're looking past the current macro environment. They view this current technological shift as an existential arms race. For these companies, the cost of borrowing money today is completely irrelevant compared to the cost of losing market dominance in artificial intelligence tomorrow.
And the scale of that arms race is, frankly, staggering. The briefing states that NVIDIA and OpenAI are currently in talks for a $250 billion backstop to fund their AI infrastructure plans.
It's an unbelievable amount of money.
It's $250 billion for just two companies. Here's where it gets really interesting for me, though. Before we even talk about the implications, what exactly is a backstop in this context? Because $250 billion looks less like corporate R&D and more like the GDP of a small country.
Right. So a backstop is essentially a financial safety net or a guaranteed line of funding. When you're building infrastructure at this unprecedented scale, massive data centers, dedicated power grids, custom silicon foundries, you're signing contracts that take years to fulfill.
Sure, you can't build a power grid overnight.
Exactly. So the suppliers need a guarantee that halfway through a 5-year build, OpenAI isn't going to suddenly run out of cash. A $250 billion backstop means they've secured a massive pool of capital.
Likely from what? Sovereign wealth funds or major banks?
Sovereign wealth funds, major institutional banks, maybe even state actors. And that guarantees the bills will be paid no matter what happens to the broader economy.
So are these tech giants now just effectively immune to the Federal Reserve's interest rate gravity? Like, if rates are supposed to slow down spending, it clearly isn't working on them?
In many ways, they are insulated, yeah. A traditional manufacturer trying to build a new factory relies on bank loans, which are dictated by the Fed's high rates. But companies like NVIDIA, Amazon, Microsoft, and Alphabet, who, by the way, the briefing notes are also planning to spend hundreds of billions on AI, they're generating historic amounts of free cash flow.
They could just self-fund the builds.
Precisely.
Yeah.
And when they do need outside capital, their balance sheets are so pristine that they can dictate terms to lenders. They are playing a completely different financial game than the rest of the economy.
And they're spending that money on physical planetary scale infrastructure.
Yeah.
Like the briefing notes, Amazon is seeking federal approval to launch over 5,000 satellites for a direct-to-device network. This isn't just software anymore.
Not at all. To grasp the mechanics of this, think about how your phone works right now. It connects to a physical cell tower, which is wired via fiber optic cables to the broader internet.
Right.
Amazon's direct-to-device network aims to bypass that entirely. They essentially want to put the cell tower in low Earth orbit.
Wow.
Yeah, if they can beam data from an Amazon-owned AI data center directly to an Amazon satellite and then straight to your phone anywhere on Earth, they own the entire pipeline. They eliminate the telecom middlemen.
That is wild. Now, while Amazon and NVIDIA are building the plumbing for this new era, the briefing points out a bit of an outlier. Apple's stock price has apparently, quote, lost the plot recently with these wild swings. But the source material emphasizes that its fundamental narrative remains intact. What's going on there?
The volatility comes from Wall Street trying to categorize Apple. NVIDIA builds the AI processors. Amazon builds the massive cloud data centers. Historically, the assumption has been that AI requires so much computing power, it can only happen in the cloud.
Right. You send a prompt from your phone to an Amazon server, it does the heavy lifting and sends the answer back.
Exactly. But Apple's fundamental narrative relies on something called edge computing.
Meaning the processing happens on the edge of the network, like right on the device in your hand.
You got it. Apple doesn't want to build $1 trillion worth of server farms. They want to utilize the computing power of the billion-plus iPhones already sitting in people's pockets.
Which is a massive decentralized network when you think about it.
It is. They're building neural engines directly into their hardware so that your AI assistant learns and processes data locally on your phone. It's more private, it's faster, and crucially, it doesn't require Apple to pay for massive server electricity.
Oh, that makes sense. So the market is currently wrestling with whether Apple's edge computing strategy can truly compete with the raw brute force of cloud-based AI, which explains the stock volatility.
Oh, exactly.
Well, because big tech is writing these blank checks, everyday traders are aggressively repositioning, and it's creating violent ripples in today's active trading.
Oh, absolutely.
The most active stocks of the day are, unsurprisingly, NVDA, Apple, and Amazon. But let's look at the extremes here. The top loser today is SanDisk. They crashed 11.7%. And the briefing attributes this drop to rising concerns over future Chinese competition in the NAND memory market.
Yeah, that was a brutal drop.
But wait, if China is flooding the market with memory chips, wouldn't cheaper storage actually be a massive win for companies like Amazon trying to build out all these data centers? Why is the market punishing SanDisk instead of celebrating the cost savings for the tech buyers?
Well, it is a massive win for Amazon, but it is an absolute death knell for SanDisk. This highlights the brutal difference between types of hardware. NVIDIA makes GPUs, right? The ultra-complex processors that actually do the math to train AI.
And that requires deep proprietary architecture.
Exactly. But SanDisk makes NAND, which is just flash storage. It's essentially just the bucket where you hold the data after the GPU processes it.
So anyone can build a bucket, but very few can build the supercomputer.
Precisely. Storage memory is a heavily commoditized market. State-backed competitors in China are aggressively trying to build domestic semiconductor independence, and the easiest place to start is memory.
Right, make the buckets.
Right. So if they flood the global market with cheap NAND chips, Amazon will gladly buy them, but SanDisk will be forced into a race-to-the-bottom price war, which completely destroys their profit margins. The market is pricing in that commoditization today.
Okay, that makes perfect sense. Now let's flip to the top gainer today. I'm looking at this crypto rally, and honestly, I am totally lost.
It's an interesting one.
The briefing says this rally is driven specifically by a rotation of capital away from AI infrastructure. If AI is the undisputed future of the economy, why on earth would institutional money pull out of NVIDIA to buy Bitcoin? They don't even share the same technological ecosystem.
I know, it seems totally counterintuitive until you look at how traders view risk ecosystems. This has nothing to do with the underlying technology of blockchain versus artificial intelligence. It is purely about market psychology and liquidity.
Okay, explain that.
For the past year, AI has absorbed a historic amount of capital. But when a sector gets so crowded that every piece of good news is already priced into the stock, traders start looking elsewhere for outsized returns. They're looking for alpha in a high beta asset class.
Wait, for those who aren't day trading out there, when you say alpha and high beta, you essentially just mean they're looking for investments that swing wildly enough to make big profits incredibly fast, right?
That is the perfect translation, yes. When the easy money has been made in AI, that aggressive, hot capital doesn't just retreat to a boring savings account. Traders rotate it into an asset class that is volatile enough to keep generating rapid returns.
And crypto serves as a massive alternative liquidity sponge.
Exactly. Traders aren't buying crypto today because they suddenly lost faith in AI. They're buying it because the AI trade needs to digest its recent gains. And crypto provides the dramatic price swings they need to meet their daily return targets.
Man, that desperate hunt for volatility is actually forcing the market's fundamental plumbing to change. Like, if capital is rotating this aggressively, the old 9-to-5 market hours just aren't enough anymore.
They're really not.
The briefing notes a drastic shift. The CME, the Chicago Mercantile Exchange, just launched single stock futures, allowing investors to trade specific companies like SpaceX and Micron 23 hours a day. Now, for clarity, a single stock future is basically a contract to buy or sell specific stock at a set price on a set date in the future, correct?
That is correct. It allows investors to take a massive position on a company using leverage without actually having to buy the underlying shares on the open market immediately.
Right.
And historically, the stock market had a defined opening and closing bell, which allowed the system to settle accounts and, gave human traders time to sleep.
Right, which seems necessary.
You'd think so. But by opening up 23-hour trading on these derivative contracts, the CME is bending to the reality of global capital. If a major supply chain disruption happens in Taiwan at 3 a.m. Eastern Time, institutional investors demand the ability to short Micron or hedge their SpaceX bets instantly. They don't want to wait for the New York Stock Exchange to open 6 hours later.
The market is demanding near instantaneous liquidity, and a lot of that immediate movement is going to be driven by earnings season. Applied Digital announced its fiscal Q4 and full year 2026 results today.
Yeah, and while they aren't a household name, they build next-generation data centers, which makes them a really key indicator for how fast this physical AI infrastructure is actually coming online.
But the main event looming over everything is obviously Amazon. The market is bracing for their Q2 2026 results on July 30th. Expectations are set at $1.88 earnings per share on a massive $108.8 billion in sales.
It's huge, and when Amazon reports, the market will actually largely ignore their retail e-commerce numbers. Yeah, all eyes will be on AWS, their cloud division. Because AWS is the backbone for so much of the world's AI processing, their revenue growth acts as a crystal ball.
So if AWS shows even a slight deceleration in growth,
It could send a shockwave through the entire tech sector. It would signal that the appetite for AI compute power might be softening.
which would be massive. Now, that desperate hunt for recurring revenue isn't just happening in AI and crypto, right? It's forcing everyday legacy brands to radically overhaul how they extract money from you, the consumer.
It's happening everywhere.
Let's look at the media and transportation restructuring mentioned in the briefing. NBC Universal and YouTube just struck a deal to embed the Peacock streaming service directly into the YouTube video platform for premium subscribers.
This is a really major concession regarding distribution. For years, every media company tried to build their own walled garden. They wanted you to download their specific app and pay them directly.
But consumer exhaustion has totally set in. People don't want 20 apps.
Exactly. So by embedding Peacock inside YouTube, NBC Universal is acknowledging that YouTube owns the audience pipeline. They're willingly giving up control of their user interface and likely a cut of the subscription revenue just to reduce the friction of getting viewers to actually watch their content.
And we're seeing a similar unbundling and restructuring of how you pay in transportation. JetBlue has completely overhauled its fare options, introducing new basic and flexible economy tickets.
Which is pretty standard airline stuff.
Right, we're all used to airlines unbundling tickets, charging extra for a carry-on bag or a window seat. But here is the detail in the briefing that actually made me stop reading. It says the automotive sector is mirroring this, specifically noting that Ford is overhauling its fare options and expanding its accessory and parts business.
Yeah, that phrasing is very intentional.
Ford is building cars, not flying planes. The phrase fare options is so bizarre here. What does that signal?
It signals a profound shift in the fundamental business model of the automotive industry. Historically, Ford's model was entirely transactional. They spent billions building a factory, they sold you a truck, collected their margin, and rarely saw you again until you bought another car a decade later.
Which is a highly cyclical, low-margin business that Wall Street fundamentally dislikes.
Exactly. Wall Street prefers the software model, where a customer pays a monthly subscription fee indefinitely.
So automakers are turning the physical car into a software paywall.
Yes. It is actually cheaper for Ford to install heated seats and advanced autopilot hardware into every single car on the assembly line to streamline manufacturing.
But when you buy the car, those features are digitally locked.
Exactly. To turn on your heated seats in the winter, you have to pay a monthly fare to unlock the software. By expanding their accessories and digital parts business, Ford is trying to convert drivers from one-time hardware buyers into ongoing monthly subscribers to their own vehicles.
So you're essentially paying a basic economy fare just to drive the car off the lot, and then upgrading to first class through a software update. It entirely redefines the concept of ownership.
Yeah, you transition from owning a vehicle to licensing its capabilities.
Man. Well, we have covered an immense amount of ground in today's July 27, 2026 briefing. The grand theme connecting all of this is the intense, almost violent friction between macroeconomic reality and unbridled technological ambition.
Absolutely.
We've got the Federal Reserve actively fighting to keep the parking brake on the economy, terrified of a wage price spiral while navigating geopolitical energy shocks and political demands.
And completely ignoring that parking brake, the technology sector is just pressing the accelerator through the floorboard. $250 billion AI backstops. Thousands of low Earth orbit satellites bypassing traditional telecom and capital rotating at light speed between AI and crypto to chase that volatility.
The macro environment is trying to set the boundaries, but the technology is just rewriting the rules of the game within those boundaries. And it matters because these shifts are dictating everything from your grocery bills and mortgage rates to how you watch media to the monthly subscription you might have to pay just to use the features in your own car.
It's all connected.
Which leaves me with a final thought I want you, the listener, to mull over today. We talked about the CME launching 23-hour-a-day trading for single-stock futures like SpaceX, acknowledging that global capital basically never sleeps. And we know these massive new AI infrastructures are being designed to operate, analyze, and optimize supply chains around the clock.
Yeah, we've engineered a global engine that fundamentally does not require rest.
Right. So if the stock market, our financial plumbing, and our core technological infrastructure are becoming entirely decoupled from human waking hours, are we rapidly moving toward an always-on economy where human downtime is the only thing that isn't priced into the market?
It certainly feels like it's trending that way.
How long until our personal financial lives, our careers, and our attention spans are forced to operate 24/7 just to keep up with the supercar we've built? Think about that next time you try to unplug for the weekend. That's all for today's deep dive on Tech Money Madness. Don't forget to like, subscribe, and we'll see you tomorrow for more market coverage. Keep exploring.